I'm John Kosar, Chief Market Strategist at Asbury Research. Thanks for listening to our latest Following the Money podcast. Today is October 22nd, 2023. Today I'll be talking about what our latest analysis and data-driven models are saying about current financial market conditions. That is, when to be on offense and looking for opportunities, and when to be on defense and protecting your capital. Now let's follow the money. I have 5 important bullet points for today's podcast. Number 1, many major U.S. stock indexes are testing major support levels right now. In the benchmark S&P 500, that support is at 42.33 to 41.95. These support levels are the likely starting point for the U.S. stock market's next 1 to 2 quarter directional move, so Asbury Research believes that there is an exceptional opportunity here. Asbury Research subscribers can log into the Research Center for more charts and detail on this. Number 2, seasonality is very strong during the month of November. Our data shows that the first 2 and the final week of November are the 3 seasonally strongest weeks of the entire fourth quarter in the S&P 500 based on data since 1957. The annual and quarterly charts that pertain to this are available in the Research Center. Number 3, our CEF model is overweight the energy sector. CEF is our own in-house model that stands for Sector ETF Asset Flows, and as the name suggests, it follows the money around the 11 sector spiders, which together are the S&P 500, to try to get on board new trends as early as possible by simply following the money. The energy sector ETF XLE has been favored by the CEF model since July the 31st and has since outperformed the S&P 500 by 13%. Energy has by far been the best performing sector over the past 3 months, according to sectorspiders.com. As long as the energy sector retains its current favored ranking, according to the CEF model, recent outright and relative outperformance is likely to continue. Number 4, 10-year yields are testing long-term overhead resistance at 5% to 5.23%. 5% is a very important psychological level, and 5.23% is the July 2007 and June 2006 benchmark high yields in the 10-year. Correlation analysis suggests that how yields respond to this key level in the upcoming weeks is likely to have a strong influence on the direction of the U.S. stock market as we head into 2024. Finally, number 5, we have recently launched our CPM Plus model. This model was developed for older and more risk-averse investors that want to or need to participate in the stock market but can't afford to take a large drawdown. You can learn more about CPM Plus by visiting asburyresearch.com, choosing models across the top of the screen, and scrolling down to the correction protection model. So there it is, our latest bi-weekly Following the Money with Asbury Research podcast for today, and a short synopsis of what we think is particularly important to pay attention to as we move into the winter months. By the way, I will be a guest on the Schwab Network tomorrow morning around 9 a.m. Chicago time. That's Monday, October the 23rd, and I'll be talking about some of the points that I covered here today, and there'll be some accompanying charts. So I hope to see you there. Look for us again in about 2 weeks for our next Following the Money podcast. In the meantime, make sure you subscribe to the Asbury Research channel on YouTube for more podcasts and data-driven trading and investing information just like this. If you're interested in subscribing to our premium content, you can contact us at asburyresearch.com before October 31st and get 10% off the price of a 3-month or a 12-month individual investor subscription. Now we close with the legal stuff. This podcast is provided for information purposes only and is not intended to be a solicitation to buy or sell securities. The performance indicated from backtesting or historical track records may not be typical of future performance. No inferences may be made and no guarantees of profitability are being stated by Asbury Research, LLC. The risk of loss in trading of financial assets can be substantial. Therefore, you should carefully consider whether such trading is suitable for you in light of your financial condition.